Right now, Hertz Global Holdings, ticker HTZ, is trading at $7.02. That is an explosive face-ripping surge of $2.08, or 42.11% on the day. This is not a glitch on your Robinhood app. This is not a data error. This is one of the most violent stock market reactions we have seen in a company of this size all year. And it is a direct, brutal, and immediate response to the company's third-quarter earnings report that was just released. The market has been treating this stock as a walking corpse for the better part of a year, a company teetering on the edge, a failed experiment. The universal expectation was for more pain, more losses, more failure. The reality, dropped on the market this morning, was a profit. This 42.11% surge isn't just a rally. It's a panicked repricing of a company that everyone had left for dead, and it has all the hallmarks of a historic, brutal short squeeze. The common belief, the narrative that has defined Hertz for the last 2 years, has been one of unmitigated disaster. This is the company that fumbled its emergence from bankruptcy with one of the worst strategic blunders in recent corporate history: the massive high-profile purchase of 100,000 Tesla stock vehicles right at the top of the market. The idea was to look forward-thinking. The reality was a financial catastrophe. The repair costs were astronomical. The depreciation on those EVs was a black hole that consumed the company's balance sheet. Quarter after quarter, investors using their SoFi Invest or Fidelity mobile app would check in only to see Hertz posting massive losses as it was forced to liquidate that very same EV fleet for pennies on the dollar. The stock price reflected this pain, bleeding out from its post-bankruptcy highs all the way down to just a few dollars. The consensus on all major investing sites was that this company was broken, burdened by nearly $20 billion in debt, and was likely on a path to a second bankruptcy. Analysts were forecasting another loss for this quarter, with the consensus sitting at a loss of 2 cents per share. That was the expectation, a funeral. But the reality that was delivered today was a resurrection. Hertz didn't just beat expectations, it absolutely annihilated them. Instead of the expected loss, the company reported an adjusted profit of 12 cents per share. This is the first time in 2 full years that Hertz has posted a positive earnings per share. This is the inflection point the market was not prepared for. And it wasn't just a financial gimmick. Revenue also beat expectations, coming in at $2.5 billion. But the real story, the how, is the most important part. This profit was driven by the company finally fixing its core problem. They revamped the fleet. This is a polite corporate term for what they actually did. They sold off the disastrous Tesla stock fleet and replaced it with brand new, efficient, and, most importantly, profitable gas-powered cars. The effect was immediate. Depreciation per unit, the metric that was destroying the company, absolutely plummeted. It fell 49% year over year. They are finally managing their primary asset, the cars themselves, in a way that makes financial sense. On top of that, they achieved a record-high fleet utilization of 84%. And they're getting smarter about selling their old cars, moving them direct to consumer and capturing $2,000 or more in extra margin per vehicle, rather than just dumping them at wholesale auctions. This isn't just a beat, it's a sign that the entire operational strategy has been reset. This brings us to the violence of today's 42.11% move. This isn't just long-term investors performing a new online investment calculation and buying in. This is a war. For months, Hertz has been one of the most heavily shorted stocks on the market. Data from just before this report showed a short interest of over 42%. That means for every 100 shares in the public float, 42 were held by short sellers, traders, many on professional interactive brokers platforms, who were all making a one-way bet that this stock was going to zero. They were borrowing shares and selling them, planning to buy them back for pennies after the company collapsed. But today's 0.12-cent profit was a cannon shot to their entire thesis. It triggered a massive panicked short squeeze. All of those traders who were betting on failure are now being forced to buy back shares at any price to close out their losing positions. This forced buying creates a feedback loop, a demand vacuum where there are simply not enough sellers. This is what you're seeing in real time. This 42.11% surge is a combination of new buyers believing in the turnaround and old bears being carried out on a stretcher, forced to buy back in at 6, 650, and now 702. The options market is reflecting this chaos, with call option volume, bets on the price going higher, exploding by more than 5 times the daily average. This is the ultimate disconnect between the old story and the new data. For the self-investing community, this is a moment of pure whiplash. The company was untouchable, a pariah. It was the opposite of a stable, cash flow-rich machine like Apple stock or a high-growth monster like Nvidia stock. It was a low-margin, high-debt, poorly managed industrial company. You wouldn't find Hertz in a conservative Schwab Intelligent portfolios or a Fidelity IRA. You would find it in the speculative, high-risk portion of a Robinhood stock trading account. But this quarter changes the math. The company also shored up its balance sheet, raising $425 million in new notes to give itself more breathing room. It now has $2.2 billion in liquidity, including $1.1 billion in straight cash. This isn't the profile of a company going bankrupt next month. This is a company that has bought itself significant time. However, the tension is not completely gone. This is where the deeper investment help comes in. Even as the stock is exploding upwards, Bank of America reiterated its underperform rating this morning, maintaining a price target of just $3.10. That's less than half of the current trading price. Why? Because the core long-term problem hasn't vanished. The company is still sitting on a mountain of total debt, close to $20 billion. This 1 quarter of profit is a massive achievement, and it proves the new fleet strategy is working. But it is 1 quarter. The bear case is that this is a dead cat bounce, a one-time short squeeze-fueled euphoria that ignores the massive interest payments the company has to make on that debt quarter after quarter, year after year. The bears will argue that this rally is an overreaction, and that the long-term crippling weight of the balance sheet will eventually pull the stock right back down once the squeeze is over. They would point out that a stable investment in a Fidelity mutual fund or a broad market Fidelity ETF is designed to avoid exactly this kind of heart-stopping volatility. This sets up 2 very clear future scenarios. The bull case is that today, November 4th, 2025, was the official bottom. This is the inflection point. The new management team has proven it can execute. The EV nightmare is in the rearview mirror. The company will now use this positive momentum and its improved cash flow to systematically chip away at its debt. The 42% short interest is being permanently destroyed, and a new base of long-term investors, perhaps using their Fidelity brokerage or SoFi active investing accounts, will begin to slowly build positions believing in a multi-year turnaround. In this scenario, the BOA analysts are wrong, and the stock will establish a new higher floor. The bear case is that this is a one-time event, a get-out-of-jail-free card that the company can't play twice. This quarter's success was the easy part. They sold the bad assets. Now comes the hard part, operating in a competitive travel market with $20 billion in debt on their books. In this scenario, the squeeze ends, the volume dries up, and the stock's gravity, its debt-to-equity ratio, pulls it right back down to $3, proving BOA correct. This is a true battlefield, and the stock is the territory everyone is fighting over. I have to ask everyone watching this, comment below if you think this 42% surge is the first day of a real recovery for Hertz, or is this just the biggest short squeeze of the year that will be over by next week? Let me know what you're thinking. As Hertz trades at $7.02, up an incredible 42.11%, we are watching a perfect Wall Street drama. The expectation was that Hertz was a dead company, a tragic story of a failed bet on Tesla stock that would doom it to a second bankruptcy. The reality is that the company ripped off the Band-Aid, pivoted back to a strategy that actually works, and posted a stunning, unexpected profit. This new reality has triggered a violent short squeeze, as all the investors betting on failure are forced to capitulate. The company has proven it is not dead, but the long-term question remains: has it truly been saved, or has it just delayed the inevitable? The market is euphoric today, but the $20 billion question of its debt still hangs over it all. Disclaimer.